Okay, well, appreciate everyone being on this Monday evening. My name is Dustin Miles. I'm one of the partners at Momentum Multifamily, and then Hayden, my business partner, is on as well. And so, yeah, super excited for you guys to just kind of go over what we've seen. Not even a year now. So. Um, but yeah, we'll kind of jump into it. So this is an asset, just to give you a little bit of background. It's an asset we bought last September, so late September there, and it was a seller had some issues going on in the background, and but yeah, we'll kind of get into it here. So yeah, beautiful asset. 2018 deal. The cool thing is that we actually own the deal next door, so you can see the roof line back here. It shares a fence line, which is really cool. And so, but yeah, we were able to buy it. It was funny. Whenever we were looking at the deal, I don't know if you remember this, Hayden, but so it's been a little bit, but we initially, when we started looking at the deal, the price was up here, and we weren't honestly super interested in it. And we kind of check in and check in and check in. Every time we talked to him, that price just kept coming down. And so we're like, okay, this is getting interesting. So, but yeah, it's been, beautiful asset, shows, really, really well. And then, like I said, we own the deal just next door. So we had tons and tons of data. And we'd owned the deal next door, I guess, for about five years at the time, so we're close to 4.5 or so. But yeah, I'll yeah, kind of go over to the next slide. And Hayden, if you want to kind of jump in.
Sure. Yeah, something that we liked about this product too was it had a slightly different offering than the property that we own next door. The Henry at Liberty Hills, which is the neighboring property that we've owned for a while, is a kind of traditional garden style asset, 3-story, external breezeways, that sort of thing. And this is a 4-story wrap product. And so it was a little nicer asset, a little different offering. The interiors were nicer. And it's kind of a different resident base as well because we had an affordable component to the property next door. So when we were looking at this deal, it allowed us to step into a submarket that we had a lot of experience in. So that's, taking that variable off the table because that's always kind of a big unknown entering into a market that you don't have experience with. Um, so we already had that, which was a great piece of the puzzle. And so we had the operating history with the deal next door. We had the rents of the deal next door, the expense ratio. I mean, we had all of the data, and we knew where this property could get to. Our property next door actually had higher rents than this property did. And we were just running. We had higher occupancy. All in all, we were just doing better next door. And this property here was 6 years newer and a higher class property. It was that wrap with nicer finishes than the garden style deal that we had next door, that also has an affordable component to it too. So we saw it as the ability to capture all the traffic that walks through the door at either community in a submarket that really is in the path of progress and also has limited amounts of supply. So we typically look for markets just to begin with that don't have tons and tons of competitors. So there's probably 5 or 6 properties in this little submarket that are kind of our immediate comps here. And there's some other submarkets um, off Westheimer. I always kind of go to that area of Houston. If you guys know Houston, Westheimer area has a ton of supply. There's apartment complexes all over the place, and that's not what we typically look for. So this area is really good, had a low amount of supply, and we already had the operational history and it offers a different product to what we already own. So we looked at it as any prospect that walks through the door, we're going to try to capture them. If they want something that's a little bit more affordable, we send them to the Henry at Liberty Hills. If they want something that's a little nicer, we send them here to the Henry at New Forest. So we had offerings for everybody. And on top of that, this area is just on the south side of Generation Park. And Eli Lilly is putting a $6.5 billion facility in there right now. Bristol Myers just announced they're putting I think it's $2.3 billion facility neighboring where Eli Lilly is going. So there's, almost $9 billion worth of projects coming in right down the road that's gonna, bring a ton of jobs, a ton of growth to this area. And as Generation Park really evolves and gets built out, this asset is, both of these assets are really going to benefit from it. So we really liked the history that we had in this area. We liked the product that it offered. The physically it had great bones, 2018 vintage. So by the time we bought this property, it was only 7 years old. It needed a paint job. It needed a little bit of cosmetics. We'll show you some before and afters as we get into this presentation, but we could kind of see through the current status of the property and just see the potential that it had. And then, looking next door, we saw the financial opportunity as well, where, we knew they were heavy on expenses. We knew where we could, potentially take rents and, just their overall presence, digital and on-site team. There was a lot of room for improvement there too. I remember shopping the property. I always like to secret shop properties, and I remember shopping the property, and it had this like vinyl decal over the glass doors, so you can't see inside. And when I went to open it, I remember it being locked, and I was immediately like, "That's an immediate turnoff because you don't know if they're closed, are they open? Why is it so hard to get inside?" It did not give a good first impression. And I was about to leave. I had turned around, started walking away, and somebody finally opened the door for me. So right there in that moment, I knew there was room for opportunity just on the operations side, and plug a team in there that really cared and wants to invite people in and not keep them out. And we just saw that there was a lot of opportunity. So having that experience in the market, and then also having resources close by, and then like Dustin had shared, the price just kept getting more and more attractive. And so yeah, I mean, it's 246 units, so 34.4 on that previous slide is what we purchased it for, which is just under 140,000 a door for 2018 product in Northeast Houston is very attractive. Um, we're kind of capitalizing on the seller's distress. They had done a lot of partnerships with a large operator that um, just their business plan was going well while the times were good, but when the when the tide turned, everything kind of fell apart, and they were a lot of the equity on that, so they had to sell a lot of their deals to shore up equity, and this was one of them. We kind of jumped at the opportunity when we saw that.
Yeah, awesome. Um, so yeah, there's a lot of work, that goes into these deals. There's one thing, oh, I did want to mention too, just kind of as jogging memory on this deal and all that. So we actually weren't the highest bidder on this deal. There was someone at least going into the best and final, someone else was 500,000 above us. I don't know exactly where it shook out at. We didn't get all the way there. I think I can't remember. We maybe got halfway there. And I don't know if the guy raised his price, north of where he was at before. But so I mean, it means to, it's big deal to have, experience, have a track record, and be able to, do what you say you're going to do. And so the seller, ultimately went with us because of that. Help we own the deal next door. And then the lender, Freddie Mac, was also super, very interested in the deal too. So we have, Freddie loans on on each deal. So anyways, but yeah, there's a lot that goes into this. There's on the physical side, unit walks, walking every unit, the property condition assessment, assessing the capex signage, and you're kind of doing a lot of these in parallel. Um, and then also, before you close, obviously we do, spend a lot of time auditing the financials, auditing the leases, just trying to make sure that, everything is what it says it is. And then we're kind of on this third, piece down. There's the, digital and the team. And so we're trying to, make sure, do we were we impressed with the team members? Were we not? And figuring out where to where the chess moves should occur. So on this particular deal, we brought in a new manager, someone that we had experience with. She was So this was a promotion for her. She was an assistant manager at another property of ours, just right down the street, probably all of 7 to 10 minutes just down the road. And so she's done a fantastic job. Just great, great attitude all around. She's done really really well. I think they're 95% occupied right now today. So they've done a really good job. And then she's just their whole team is just bonded really well. They're probably they do they really like to do some of the social media stuff, and they have a lot of fun with it and all that, which is really neat. But there's a lot that goes into just kind of on that front end before you close. And then you gotta then there's the loan part, and there's raising capital and all that good stuff too, that's not necessarily captured here. So and then once you close, then the work begins. So we got off. One thing that really helps is just we've done this over and over and over, time and time again, and we're doing the same thing over and over and over. It's kind of like we think of it like if anybody are football fans, we're running the same play in football over and over and over. If you run the same play every time, you're bound to get really good at it. And so and we're working with the same contractors, working with the same vendors, working with the same management company. And so everyone knows exactly what should be going on. We treat everything like a franchise, and so everything is run the exact same way. So we were able to get temporary signage, out there the day we closed. Our teams took over. We got, I can't remember because it's been almost a year. I can't remember exactly when we got, the paint going and all that, but it was, very, short time, after we closed. And again, we're not having to, there's not, but a whole bunch of guesswork or anything like that. And our contractor had done this same thing over and over with us. But yeah, Hayden, anything else you want to kind of add on this slide?
Probably not on this one, but the next one kind of builds off it. So I can just pick up there. But yeah, like Dustin said, a lot of the work goes into, before you even close. Last thing you want to do is be scrambling the day you close on an asset. I remember actually the deal next door, Henry at Liberty Hills, was the first deal we bought in Houston. And that one was bought from Sync Residential, and Sync was very protective over their brand, similar to how we operate. And the day we closed, they stripped everything of Sync off the property. And so it was basically a bare property. And so we got a early and quick wake up call whenever we took over that asset on the importance of having all your ducks in a row, everything ready prior to closing on an asset. Because the last thing you want to do is not have people know how to find the property, not know what the property's called, not have your brochures on site for the staff to give out to prospects, not have your website and all that stuff designed and set up. So, you know, whenever we first developed the Henry brand, we were exposed to that, and we're very adamant that we want to have all this stuff ready to go so that the moment we close on an asset and it changes hands, we have our brand, we have the property representing well so that people know how to find it, they know what it's called, and we can maximize and capitalize on every single day that we have to lease this asset. So yeah, a lot of that work goes on prior to closing, and then especially if you're doing an interior renovation program, or any large capex projects, right? Having your teams assembled, ready to go, a game plan on how you're gonna orchestrate them. Like for instance, this one we had closed at the tail end of kind of the leasing season, and so we immediately started on the curb appeal, which was the exterior paint. And then as we moved into the slow season, which are the winter months, when not as many people are moving around, that's when we tackled the clubhouse. So again, we'll show some of this before and after, but you got to be strategic about how you go through and implement your plan too. You don't want to just go in the middle of summer or leasing season and start tearing apart a clubhouse. That is not good. You don't want a lot of your traffic during peak leasing season walking into a construction zone, right? So you've just got to think about all of those things. You got to plan those out and get with your different vendors to have all of that ready to go. Same thing on the financial side, like Dustin said, during the due diligence phase, while you're under contract, you're going and walking every single one of the units. You're getting reports on the condition of those units, the different finishes, verifying that who's on the rent roll is in that unit. All of that information you're compiling, you're auditing, and you're making sure that you have a game plan for when you take over this asset, you're ready to go. And we'll talk about it a little bit more too, but there's always typically a little bit of a cleanup phase too, especially with a property that is sometimes distressed. And so there was a little bit of a cleanup component to this deal, and we'll kind of get into that. But in general, that's something that we're always kind of prepared for and expecting. But again, if you haven't done it before, you may not really understand or know what that looks like. But so we did have to re-tenant a little bit and get some of the bad tenants out and then lease it back up with some good tenants. But thankfully, like Dustin said, we actually placed our manager here from a sister community. She was an assistant manager, and we gave her a promotion because she was ready for it. And she's been great, and she handled it really, really well. But while you're under contract, basically, you're getting all that stuff, all that planning out of the way so that the moment you take over, your team can take over. You have all of the materials, everything ready to go. You can start the construction, and you can really maximize every single day because every day, for instance, on average, every day a unit sits vacant, it's about $50 of vacancy loss that you're losing. So the quicker you can lease those up, get people in there, have that property show well, all of that stuff really does translate to the bottom to your bottom line.
Hey, Hayden. I'm
Yeah,
sorry. May I interrupt you before you go any further? Is it
sure.
okay if I ask a question, or should I wait until the last until the end?
We can do a question. Yeah.
Well, first of all, I met you guys. I had a pleasure meeting both of you at San Diego about a month ago uh,
Mhm.
or so, and so thanks for inviting again. And I'm in a similar situation for about 180 unit multifamily acquisition. Um, I was just curious. The you said that the price, the acquisition price was about $140 per square foot. I mean, excuse me, per door. What was the market rate?
Yeah, so we paid 34.4 million for this deal, which translates to it was like 139,000 some change door, so just under that 140 mark. The market there was a property just down the road north of the Beltway that I think it was Fidelis that traded for like 180. So we really
Yeah.
liked that too. Especially in this market, being able to have sales comps that you can point to and look at that traded recently
Mhm.
for higher than your entry point, that makes you feel really good. And there is a decent amount of that
Mhm.
happening. And in this submarket specifically, it's a little bit. I'd say that deal that traded for about 180. That area's a tiny bit nicer, but it's literally straight north on the Beltway, so very comparable.
I see. The deal that I'm trying to acquire, um, it's a different market, but it's the market. It seems to be about like $380 per door, and and I made an offer for about 290, okay, per door. But the issue seems to be the seller wants essentially stabilized valuation on an
Yeah.
unstabilized asset right now. Okay. So I was trying to understand. I mean, you said that you had other offer that actually paid like half a million more, right? So what was the like seller's sort of what is motivation on his part? It would, and I think you mentioned the reason, but trying to understand, how to negotiate this with the seller. When the seller wants, it's a brand new property. It's like only 2 years old, so it's a new property. It's but the seller a managed kind of asset, and clearly they mismanaged the problem and it's giving a lot of concession, very heavy concession. I think it's just fill the occupancy and stuff.
Yeah, it might be something we could chat with offline too.
Yeah. Uh-huh.
Yeah, just to, stay on the same track here. But in general, the reason why, they went with us versus the other guy was certainty of execution because we've bought multiple deals,
Mm.
this size range before, and we own the deal literally next door, shares a fence line. So that was a lot of conviction, for this seller to, not receive as much money. The
Mm.
other guy was not proven, didn't know anything in the market. And so he came from a very large shop. And so
Mm.
he was kind of hanging his hat on that, but he hadn't actually transacted. And that's why they ultimately went with us.
I
So
see.
yeah, then I'm selling the deal right now, and we went with the third highest bidder, and it was certainty of execution on that one too. So
Mm. Okay.
yep, yep,
All right. Thank you.
yeah, absolutely. Um, so we on this one, like I said, and Hayden mentioned, multiple times too. So we had a lot of data on this particular deal, and especially with owning the deal next door, and and we've seen this deal had floated off market prior, so we've had plenty of financials and all that too. So the we were able to decrease expenses quite a bit. Income side's been a little more challenging just with, honestly, concessions, some concessions in the market, but it looks like those are starting to peel back, right now. But overall, we were able to increase the NOI, pretty considerably. There was just, a lot of, it's a lot of basically turning of knobs, and you turn, a handful of knobs, and, that can really turn into some major dollars. So, I remember there were a handful of things, Hayden mentioned that, he walked up to the clubhouse, couldn't even tell if they were even open, the door was locked. Like, it's, not the best first impression. I remember when we toured the properties, so they knew we were, the potential buyers, the broker was there and all that. And we went to go see not one model unit, but two model units. They had two. And you don't really see that there's no real gain by having, that extra unit. And then on top of that, yeah, I remember walking in there, and because for me, this is like nails on a chalkboard. I just heard the toilet running. And I'm like, well, that's just, mine's literally going down the toilet. So, there's just a lot of really, small things that can add up, over time. And, but yeah, Hayden, I don't know if there's anything else you want to add to this.
Yeah, we can talk about it in a little bit more detail in the next one. So if we go to the next one, we can kind of show you guys what that translated to. So, like we had mentioned too, you can kind of see there in the middle one, their expense ratio was 56.6%. And that's pretty high for a conventional deal. You really want to be, high 40s. Anything over 50, you start to get into a little bit of excessive territory. And so we saw that immediately, and we're like, hey, there's a lot of opportunity right there. And like you saw in the previous slide, our income's been about flat. There was a cleanup phase, and that's part of that. Whenever you have to go through a cleanup, it's tough to raise income, but we were able to maintain it pretty well. And you can still drive NOI though at the same time. Obviously, we saw a lot of opportunity here on the NOI side. So that's a delta of 12.29%. So every basis point or BPS, that stands for basis points, is 1/100th of a percent. So that basically means that we moved it 12.29% on the expense ratio. So we reduced that expense ratio by over 12%. And between that and where our income came at, that ended up to translating $419,000 growth in NOI since we've owned it. Um, so obviously a lot of this can come from expense mitigation. And so you don't always have to drive income to be able to drive the NOI or the property value because ultimately that's how it's valued. So even in tough markets, there's the ability to move the NOI. We've seen this at some of our other properties as well. And and so that's what we've really been focused on. And now, like Dustin shared too, yeah, we're 95 and some change percent, physically occupied. We're almost 98% leased, and we're trending just under right at about 96. So as that occupancy continues to stay in the mid to high 90s, then we'll start pulling back those specials, and that's ultimately what's going to really drive the income from here too. So that will help, move the NOI as well. The first year of ownership is typically getting to know the property. Again, that cleanup phase, um, and then implementing your value add business plan. So a lot of that has been done, and we're excited to show you in a few slides here. We've got some really cool before and afters, but yeah, if we want to go to the next slide too, Dustin, we can kind of show how that broke down, kind of per unit. There's controllable and non-controllable, your taxes and insurance. There is a little bit of control on that. Some people think they're truly non-controllable, but like in some instances on one property, we replaced a roof, and we are able to get a reduction in our insurance there by moving everything to a master policy with our whole portfolio. We're able to see some savings there. So there are some controllable elements to taxes and insurance, but for the most part, you're a little more limited on what you can do there. And then you can just kind of see line over line, kind of how your expense load is basically broken up. So yeah, we've been able to run it at a savings to how the seller had done it, and the seller had owned it. They had owned it since I think since it was built. I think they bought it right after it was built in kind of 2018, 2019. So by the time we got it, they had owned it for 6 or 7 years. And sometimes too, especially larger groups. This is a large group. I think they own something like 30,000 units. And again, they had some pain in their portfolio that their attention was on. And so when that happens, you take the foot off the gas. If it doesn't get attention, the on-site team, if they don't have the oversight that they need, things get a little out of hand. Things get a little, expenses may go up. They may be buying materials when they can do it in-house, sort of thing. So when you don't have that oversight and you're not there constantly, that's where some opportunity can come in as well.
Yeah. So, I guess as far as so some of the biggest contributors to other income were utility capture and billing, the technology and internet package, Valley Trash and Doorstep, late admin, and then parking, garage, and storage. And so anyways, I guess Hayden, did you want to add anything to this?
Yeah, one thing I will add to this is, something important to note is you can see there we're basically carrying 16% of effective gross income. So we're actually like per capita per resident, we're collecting more other income. So you can see the seller averaged about 14%. And we've moved that by about 2% when looking at other income. And why that's important to us is because as your rents, as your market rents continue to grow, then things are just going to look even better from there. So and especially as occupancy, like that's based on probably a 92, 93% occupied. And we're, like we said, 95 trending 96. So that'll increase even more. So that's something too that as concessions burn off, as the market improves a little bit, because currently what we're experiencing here in Houston, especially, is when the Fed raised interest rates, developers stopped building, and they stopped building in Houston first, and then some of the others like Dallas and then Austin. So Austin is the most oversupplied market in Texas right now. It's one of the most oversupplied markets in the country, and that's why they have severe negative rent growth. But Houston, since builders stopped building there first, the delivery pipeline dried up the quickest. So we've only got 1.5% stock of the total stock set to deliver in 2026, when you normally average 3.5, 4. So you're at a third to a half of what would normally be delivered, and at the same time, there's still just as many people moving here. I think last year it was 127,000, something like that, people that moved to Houston. So when you have that many people, but I think this year they're only set to deliver like 7,500 units total in new supply for the whole city. And so that combination is what we're getting excited about, because just like over the past few years, it's been very challenging where your expenses were rising on you, your interest rates were rising. Now some of that stuff's starting to come in. Your insurance and taxes are both coming down. Interest rates, at least they're kind of stabilized. They're still high, but if those come down, things are, I think, going to get really crazy. But we were looking at some trade out reports even today in some of our deals in our portfolio, and we're starting to see positive trade outs, like really positive trade outs.
Yep.
And so, especially, our focus over the last year, really past few years, has been, most of you have probably heard this, but heads and beds, keep people in place so you don't have the turn cost or the vacancy cost. And a lot of times your trade outs, which are your new leases versus your current lease, if you were to go get a new tenant, a lot of times those would be negative over the last few years. So in a down cycle, your strategy is keep people in place, high retention, keep high renewals, so that you don't have to have negative trade outs. And so that's been the focus. But as the market returns and that rent growth starts to return, because like we said, we're trending to 96% occupancy. As we start to peel back those specials, that's really going to drive income. and especially your other income when you're higher occupied, that's just going to widen that gap between what we're doing and what the seller was doing. Um, so again, something that we're pretty excited about and should feel more of the effects as we continue to peel back on some concessions and stuff.
So this is the really fun slide. This is so what all this means. So we're able to move the NOI pretty considerably in a short amount of time. And that's, as we've talked about with, there was some clean out the property. And then, rent bumps have been, challenging, especially over the past year. And so even with all that, um, we've been able to see a NOI improvement of over $400,000. Our total raise here was a little over 13 million. So within less than a year, basically we have a 50%, north of 50% increase in investor value and all that. So it's super cool, and I think that's really just the power of multifamily, power of scale is big. Obviously, if you're doing this over a few units, it doesn't really matter a whole lot. But when you have over 200 units, you're able to you have scale, and you're really able to move the needle there, and that's the power of multifamily. Some other just things. If you kind of look down here below, you can see the NOI per unit takeover is $7,500. NOI per unit today is over 9,000. So it's $1,700, per unit. So it's a lot. And what's cool is, a lot of these improvements, didn't really cost money. For the most part, a lot of them were, some of them were just, some paper changes and things like that. So we were able to, move the needle, very considerably, on this asset. And one thing that just kind of, planning ahead and all that on this. So this is it's a 5-year Freddie loan that we placed on this. We don't, know exactly when the market's going to come back. I think if you talk to a bunch of people, a few years ago, they were, 26, 27. Obviously, 26 is not. It's, pretty, it's a great time to buy. It's a terrible time to sell. And I think 27 might be more of a transition year and all that, but potentially 28, 29, I'm sorry, 29, 30 or maybe 28. So we'll see. So anyways, but it's what we did was so it's 5-year loan. We put 3 years of not defeasance, but basically we shortened the prepay there. So instead of 5 years of yield maintenance and potentially, let's say we sell at year 4, we could have yield maintenance at year 4 could still be like $1 million. And so what we did instead is we have just 3 years of yield maintenance, and then the last 2 years are 1% prepay, which is basically every multifamily loan is at least 1%. But that's pennies on the dollar compared to potentially paying $1 million. So anyways, there was a lot of thought and intention, as we were buying the deal and kind of looking out a few years as far as what the market looks like, and all that. So, but anyways, but a few paper changes and we were able to create over $7 million, and that's 7.6 million at 5.5 cap. If the market gets a little more aggressive, then that bumps up to over 8 million. And then if we're being super, super conservative, which I would think this is kind of honestly the worst time to sell. We're not really seeing deals of this caliber at a 6 cap. We're more seeing them in that 5.5 range or lower. So anyways, feel that's 7.6 is a pretty good number. But anything you want to add, Hayden?
No, yeah, nothing else there. Yeah, it's exciting to see that there's just so many ways to add value, unlike the single family market. So, you know, if you're in the single family market right now, you're probably experiencing that, it's tough out there, right? And you're tied to your comps. There's nothing you can do if the house across the street from you sells for way lower than you want it to, right? You can't change the value of your house, within broadly speaking. I know there's obviously some things that you can do and some upgrades to set yourself apart a little bit, but for the most part, you're tied to those comps that are on your street or in your neighborhood, right? And the great thing about multifamily is like we had shared, we own the deal next door, and we saw the value that could be created here. And this is just an example of getting in there, taking over the asset, correcting some things. We'll show you the on the next slide, kind of that value add that we did to it. So you can see kind of the before and after, and you can force that appreciation. So you're not tied to the property across the street, what that sells for. Um, so here you can see, just looking at the before and after. So the after, it was just tired. It was dated. It was very brown. That was probably the saddest flagpole I've ever seen there. It was just, it was bad. And, it needed some love, but we saw the potential in it. It's 4-story wrap. So it's one big building. The clubhouse is right in there in the columns. Um, and it didn't look that great. That orange was kind of a funky color. A lot of it was faded. Really small monument, but we saw the potential there, right? And we had a business plan. So this is like Dustin had shared. We've done this many times at this point. And before we even closed on this deal, we had our interior designer go out while we were doing due diligence, walk the property, get into the model, look at the clubhouse, select the colors for the exterior. We had gotten with our sign company to make sure that they had all the dimensions of that median and everything there, so that when we took over this asset, we could really hit the ground running, and that's what we did. So you can kind of see the before and after on the exterior, and it just makes such a big difference on the curb appeal when you're driving by. It just looks so much more fresh, so much more inviting than it did previously.
Yeah, and here's the clubhouse. So this is your Hayden almost didn't get in there because he thought it was closed. So trying to be funny. But yeah, this was, first impression. It was there's some neat things about it. But there wasn't a cohesive, it wasn't very clean. It was I don't know, it was definitely interesting. So we everything that we do, we want to be repeatable. We want a nice clean feel, something that ages well also. So it just wasn't the most inviting, if you could get in. So but and then on the gym, it's actually, if you just walk in, I mean, it's very, very high ceilings. It feels very grand, honestly, which is really cool because a lot of times apartment gyms, I don't know how many of you guys have been in, but a lot of times it's almost an afterthought. This is almost just a big closet in the corner. But this is well thought out. This is a huge gym, a huge makeover. Looks night and day. Just really cool all around, light, bright. I mean, it'd be exciting place to be in, exciting to work out in. And so this is a really, and the really cool thing too is, so from the clubhouse, it's a very short walk. It's 15 feet, and then you hit the clubhouse. So this is pretty much, this is one of the first things that first, because we're really big into first impressions. So this is one of the first things that tenants see, and they're like, wow, this is great. And I know we're starting to run a little short on time, Hayden, but I don't know if you want to describe your tour experience a little bit.
Yeah, yeah. I mean, the tour path is so important, and this is what you walk right by on your way to the model. You can kind of see it through those doors on the picture in the right. So that second set of doors is the main entrance to the clubhouse. Um, and so, when you walk in here, it was not impressive at all. It didn't look that good. Just looked really tired and dated. But we saw the space and we're like, oh my gosh, what apartment gym has 20-foot ceilings in it? And the funny thing is too, we wanted to have this like impact statement as you walked by it. So we actually originally were going to paint the walls black, and we actually did paint them black. But with black is very unforgiving, and you could see every seam of the drywall. And we even tried experimenting, like angling the lights, having lights that like angled away from the walls so that you didn't have that harsh, downlight on them. We tried everything we could to get this really cool, like black looking gym with these, halo lights in there. But we had to scrap that idea and pivot. It's something that happens in construction projects, and so we made the decision to pivot. That's what, getting out there, visiting with your contractor is so important, because you don't want to stumble upon a completed project and realize it looks terrible and you have to redo it. That just pushes out timelines, and it wastes everybody time, costs you more money. And again, it's an inconvenience to the residents as well. So we actually showed up when they had done test walls to do to with the black to see how it looked. Realized very quickly that wasn't going to work, and so we had to pivot and scrap that and went to the white. And so it still turned out great. But now it makes, as you walk through, that's one of the first things you see, and it's just such a cool impression as you're touring the property. This is another good example too. Like Dustin had shared, they had two model units right next to each other, a one bedroom and a two bedroom. The one on the left is actually the two bedroom, and we immediately said, no, we're going to lease that out. So we got rid of all the furniture in there. The funny thing is too, they had accent walls painted in their models, and they didn't offer accent walls, which I always think is it's training your residents to do bad habits, because you don't want them to do that, and then you have to spend all the money repainting it at the turn. So and they didn't get any premiums or anything for it, so why have it in your model, right? If you're, why show something that you're not actually offering? That doesn't make sense to us, and that's not something we like to do. But that's something that they were doing along with having two models. So we immediately scrapped the two-bedroom model. We cleaned all of that out, made it rent ready, and rented it out, and at least really quickly. So that's close to, I think, $20,000 a year in extra income right there from leasing out a model. So you take 20,000 and divide that by a five cap or a 5.5 cap. That's $363,000 in value just from making a simple change right there too. Another thing too is we wanted something, we did all new model furniture there, as you can see. And so we had something a little bit warmer. Our plan wasn't to spend a ton of money on the interiors, but we want a model unit that will show really well with what the units had. So it was a little bit more warmth in the kitchens there on the cabinets with the black appliances. The game plan here was not to go in and spend $15,000 a unit blowing out these units with new appliances, new backsplash, new flooring, or anything like that, because the units were already really good, and had a hard surface countertop. It's got nice appliances. They got double doors with ice makers in the freezers. All of the modern fixtures and finishes that most residents want. And so we just warmed it up a little bit. You can see it before, very cool. Green is not our color, so we just warmed it up, and it made a really big change.
And then here's just some after photos. You guys have seen a lot of these pictures, or I guess some of them. So there's the pool. We have a few kind of courtyards, one pool, but there's a lot of just kind of this next picture to the right of it. It's kind of outdoor. living space, so it's shaded. And it's just a really nice space. Obviously, we've seen the gym and some of the interior photos. And then there's also that bottom left is just kind of a clubhouse. It's part of the clubhouse, just kind of a nice hangout room. For people to just hang out in and just kind of they could work or they could watch some TV or something like that. So um, and then just big thing with us is just making sure everything looks really good online, or again, not to be a dead horse, but really big on first impressions. So online is a lot of times what people first see. A lot of people, sometimes people drive by and then go in, but a lot of times people are looking online, looking at pictures, looking at their homes. And so you really have to just think about um and and it's not just, I guess our whole thought behind this too is this isn't just like unit 101 or 201 or whatever. Like, these are people's homes. These are where people first life moments. Baby comes home for the first time, or some people get their first job, or some people get married. And then, I mean, these are where, people's, major life events, happen. And so, kind of creating that, where people want to spend their lives. Basically, we want, to give them the best first impression, possible. And so, that online presence is crucial.
Yeah, this is something that we're pretty excited about too. It had a decent rating, 3.9 when we took it over, but we really want everything to be above a 4. So that was really important to us. And so we place a heavy emphasis on Google reviews. So we're super excited. We moved it from a 3.9 to a 4.2. Since we took over, we had 103 Google reviews. And so, I think Google even, doesn't show certain properties under a 4 on some searches. So, we'll be more searchable. Obviously, it's a really good rating for an apartment complex too. And most people go to Google not to say good things, but but to complain, especially in this business. And so part of our strategy is, and honestly, we were a little nervous when we first implemented it. This was years ago at this point, but we implemented Google review requests at all the high touch points throughout the leasing and living process. So after you tour with our staff, after you move in, after you have a work order fulfilled, and that could either go really good or really bad. And we believed in our team and our processes, and I think that was one of the best decisions we ever made because it puts a lot of accountability on your on-site team. And at the end of the day, like Dustin said, these are people's homes, and we have to always impress upon our staff that we can never lose sight of that. And, it may be a job to them, but these are people's homes and we need to take care of them. And that's what's important. So that's what we're always conveying to the teams. I think Roxanne was on here too. Yeah, I see Roxanne on here. So Roxanne, our asset manager, she's always working with our teams, and just shouting that message from the rooftops because it's so important, and you can't lose sight of that. And unfortunately, a lot of teams do. And we've got some great employees here to have enabled that this to actually happen. Raising even a tenth of a point on your Google rating is pretty difficult, especially in apartments. So we were able to raise it over 3/10 in under a year, which we're super excited about. And on the right there, you can kind of see we've got Amped. That's an asset management performance dashboard. That's something that we've developed recently and actually integrated Google reviews to that. So it's a live feed. So as Google reviews come in, we can keep track of all of that. And anything under 4 stars is really not acceptable in our eyes, and it needs attention. So that's where they'll feed on the needs attention side. Thankfully, since we implemented this, we haven't even had any. But when they do, because it's going to happen. We're not perfect. Things happen. And but it's what do you do about them? How do we address them? And this enables us to keep tabs on them and not just let them get swept under the rug or forgotten about. And so we see it front and center. This is on our dashboard. We're looking at this every single day. And if something pops up there, we're going to see it, and we're either going to need an explanation or we're going to need to do something about it. And so just holding your team accountable and setting the standard, the expectation of at a Henry property, at a Momentum property, what do we expect out of our staff, and what sort of service do we want to provide to our residents? And a lot of that will show through in communities, Google ratings. So we actually, I think all of our communities are north of 4 stars in our portfolio. So it's something that we're super excited about. And, it's a kind of a daily grind sort of thing. So it's something that we're working on every single day. We meet with our teams each week, and this is a big part of our conversations that we have with them.
Yeah, and then the bonus structure for our managers, we also tie the Google reviews to the bonus structure too. So they're extra motivated to make sure we're in a good spot there. So we want to be respectful of everyone's time, so we'll go ahead and might kind of speed through these a little bit. But yeah, really, it's all about having systems, having everyone moving in the same direction, having SOPs, having a playbook, and just continuing to just make sure that everything's running smoothly. This isn't just it's if you don't have a playbook and if you don't have systems in place, it's hard to honestly it's hard to scale, because it's kind of like running a different play in football every play. So
yeah, and this is just kind of going back to the process on, like Dustin said, I think he said it really well, is, having those systems in place is paramount to being able to take on any growth. So we always operate with the mindset of, can we do this at scale? If not, we either don't do it or we improve the system until we can. And so that's a big part of how we operate. We don't want to grow just to grow. We want to buy the right deals in the right places, and operate them at the same level that we expect out of our teams. We want to provide them with the tools to be able to do that. So there's a lot of methodology to it, a lot of thought that goes into it, because the reality is once you take over these assets, that's when the real work starts. And what's on paper is oftentimes very different from what is in reality. So you just got to be prepared for that, and being methodical about how you operate, how you build your business. All of that stuff is super important, especially in this, because if you get it wrong, you're dealing with people's homes, and those are pretty severe consequences.
Mhm. Yeah, that's pretty much all we have. Just really appreciate you guys being on here, and we were excited about this asset. Like we said, there's been nothing's perfect. You're dealing with over 200 families, and so there's always stuff going on. But we've got a great team, great systems, and like I said, you just turn a few knobs, and we're able to increase the NOI pretty significantly, in under a year, and that's really in a little more challenging environment on the rent side, and we had to deal with the cleanup as well. So we're excited. It looks like looks like concessions are peeling back, and and hopefully be able to see a little bit of rent growth going into next year. And so yeah, we're really excited about this particular asset. Like you said, we designed the loan, paired the loan with the business plan. All of this was, done, way ahead of time. And so, we were able to, only have, 3 years of yield maintenance. So if the market does, cooperate, we will be in a good spot to sell and not get knocked over the head with yield maintenance. And so yeah, just appreciate you guys hopping on though, and appreciate your time. So yeah, don't know if there's any questions or not, but yeah, if not, we'll let you guys go. So awesome. Um, okay, well, yeah, appreciate your time. Have a nice evening, and look forward to talking to everybody soon. See you guys. Take care. See ya.
These guys.
Bye.